This radio show is a paid placement. Welcome to Wealth Michigan with the McIntoshes. I'm Mark Elliott. Mindy McIntosh, the founder and president of McIntosh and Associates, started the company back in 2004. Nolan McIntosh, with his bad attitude, we'll see how he does today. We got to turn him around. Nolan, I don't know, did Michigan State lose or something? I mean,
oh man, let's not start the show that way. That is so bad. Yeah, we're not very good this year.
Go green.
How do you go ranked 11th in the nation to not even the top 25? But,
okay, all right, you'll be all right though. You will be all right. There's no question about it. So here's the deal. We're not talking Michigan State athletics. It's kind of fun at times, certainly. I think all states have the great rivalries. So Michigan State, really fun. So I'll be a Michigan supporter today, Nolan, and you can just deal with your mean green. See how that works out. But here's the deal. If you have any questions about where you are on your road to retirement, right? When can I retire? Do I have enough? Will my money last as long as I do? Will my loved ones be okay if something happens to me? Really, at the end of the day, you just want to know if we retire, are we going to be okay? That's really what you want to know. Well, that's what the team at McIntosh and Associates here to help you do, is that put that plan together, the Dream Focused Wealth Plan that Mindy and Nolan can help with. 877-222-8849 is the number. No cost, no obligation. 877-222-8849. We'll give you that number throughout the program. Of course, you can always find out more on the website, wealthmichigan.com, wealthmichigan.com. All right, Mindy. The Fed now, for the third time this year, has raised interest rates 0.75%. March was 0.25%, May 0.5%, June, July, and now September 0.75%. And we still have two more meetings to go, November and December. I mean, is Jerome Powell and the Fed, are they really changing inflation? Are they causing more problems? And there's no way to fight it. I mean, you're going to fight inflation, you hurt the economy. You let inflation roll, maybe, I don't know. What's your thought?
Pretty tough. You're right. You can't help it. It's here. Yes, inflation has absolutely rose higher than, probably what most have expected. And when we take a look at that increase, what it really does is it creates a lot of buzz, a lot of uncertainty for, our families out there, even for listeners of wondering, oh my goodness, wow, I've really noticed that there's an uptick in even what folks are spending because of what we're seeing with inflationary numbers. Are they going to need to continue to work an extended numbers of years before they can retire? How are they going to efficiently live on the same amount of dollars, today as they were, let's say, 1 year ago? Really taking a look at having an accurate plan of taking a look and seeing, where am I at today? Where did I think I was going a year or two ago? And do I even have a plan, for what we're seeing happening today? So if you haven't planned or prepared for, what I kind of call some of the unexpected for folks, it's really important to take a look at inflationary, protected items that folks can utilize for future income. We were talking to some folks earlier this week of one of our families and taking a look at, goodness, when they retire, husband's actually still going to receive a very nice pension. Wife is not. So we were talking about, creating a pension within her 401k. And we specifically were talking about inflationary numbers right now. She happens to be an accountant, and we got into some details of numbers. And I think it's so important. We were talking about one of our avenues to give folks an inflationary protection, increasing income for them later in their retirement years, and how we can plan for that now. So if you're worried about inflation, not sure, goodness, what's going to happen in the next 3 months even, or let alone 3 years, 5 years, 10 years, please reach out to us at 877-222-8849 or visit us on the web at wealthmichigan.com, because it is definitely here. It's hitting us all right in the face of what is happening. Nolan and I have been talking about this to folks in our families for about the past 9 to 12 months and seeing the writing on the wall, but it's here and folks are now facing what we're dealt with that we need to walk alongside together.
Again, that number, if you'd like to chat with the team at McIntosh and Associates, 877-222-8849. There's no cost for this. There's no obligation. There's no pressure. Come in. Let's talk about your situation. 877-222-8849. Now, Nolan, you're the wealth management guru. You like taking the 401ks and the IRAs, and let's try to see if we can figure out how to make them better, because it is a tough situation. This year has been rocky. There's no question. My 401k is not very happy, so I don't talk to it right now. I let it go. I hope it's going to come back. Hopefully it's doing what it's supposed to, buying things on sale, and then when things come back, it'll be stronger. That's my plan, Nolan. All right. Here's some stats for you, though, from BlackRock. And BlackRock, one of those big, what is BlackRock exactly? Is it like they handle trillions of dollars?
Yeah. Yeah. I mean, they do multiple things. I mean, they do insurance, they do asset management, they do pension funds. So they're just a big company that have trillions of dollars of assets. And obviously they have a lot of technology that looks at a lot of different things that are going on globally, not in the United States.
Right. So here's some stats from BlackRock. 2 times in history, stocks and bonds were down, both down, in the same calendar year, 1931, 1969. Now it's happened for the 3rd time because stocks and bonds are down again in 2022. So that's 3 times in history that's happened. Now, the worst start for bonds into a calendar year was 1974. Bonds were down 2.7%. Okay, bonds down 2.7%. That kind of fits in with our theory that bonds are not super unsafe. They can go down, but they're not going to kill you, basically, like the market can. But the worst start for bonds, well, now it's almost 3 times worse than what it was in 74. January to July of 2022, bonds down 8.2%. That's 3 times worse than the worst time in history almost. Your thoughts?
Yeah, and we're not done. A lot of people like to use they think that, bonds are safe. We have to say that they're safer. I think you alluded to that, Mark, but they are usually, depending on the environment, safer than stocks. But in the current environment, with interest rates continuing to rise, the bonds are on a teeter-totter type of, if you can visualize that in your mind, as interest rates rise, which they just did, the bond values go down. And so this negative 8% that we're talking about from January to July is going to get worse because now with interest rates rising again in September, they're going to continue to go down. So we don't call it a challenge, we call it an opportunity. So for us, when we look at it, we don't want to necessarily always look at the glass half full or, half full. We want to look at it, from a standpoint, we want it to be a positive thing. So maybe bonds aren't the best place to be right now. So maybe we look at bond alternatives. We've talked about it on the show before, instead of looking at something of being more conservative might not be the way to go. In the market, we look at something outside of the market to give our bonds some growth. And so instead of being in bonds, then we do it on alternative. Secondary thing is we look at the stock market itself and from a standpoint of, where are we at? And you kind of talked about it with the dollar cost averaging theory of the 401k to where we're putting money in at separate times throughout the year. And so what that does, that dollar cost averaging is what that does is it, allows us to buy at different times throughout the year. So that way, we would look at our average share per price, the theory, right? Because it doesn't always work this way. But the theory states that by the end of the year, you're going to have more shares in your pocket by doing the dollar cost averaging. So, last year we were buying things overpriced, cars, homes, market, the stocks. And this year, everything's starting to come down, right? Real estate's starting to come down. Autos, you can actually see cars in the parking lot now of a dealership now. And same thing with the stock market. So we don't like to look at it again from the negative standpoint. We want to look at it as, okay, is there some buying opportunities? Is there some buying opportunities we have in the current environment? And secondarily, is there opportunities, and we'll probably talk about this a little bit later, but is there some tax opportunities that we can look at in the market instead of just looking at it negative? Because instead of freezing and holding and saying, I don't want to look at it type of thing, I think, in our opinion, we should be looking at it and saying, okay, is there something else we can look at? So there's some of those strategies that we need to look at for you. 877-222-8849. Perfect place to start is just by looking at it.
So let's touch on that, Nolan, since you brought it up, and Mindy, you can chime in. Nolan, you can do it, whatever. But you think about it, the markets are down, might be the perfect time to move money into the Roth world. How do you determine that?
Yeah, even clients of ours, so vice versa, right? So we might be doing, into a Roth conversion. We may be doing something into a different tax-free entity, through indexing life policies, things of that nature. But look at it at the opposite end. What if we are holding something that's safe that doesn't have any market loss? It might be a good time to get in. So maybe we're taking some of those monies that are in the safer havens and putting that back into the market. So we're looking at it on a two-way street here for us, is that there's possibility of time to put it into the market, and then also from a tax strategy standpoint, when the markets compress, we're able to convert more shares than we would be back in 2021 because the share price was higher. So, and then obviously if the assumption is, right, we can't guarantee anything, but the assumption would be as the market grows, now that it's going to rebound eventually, now we have all this tax-free growth that we have. So it's a very, very succinct time. A lot of times, advisors say just hold on and let's not do anything. Right now we're talking to clients and saying, hey, let's look at least the opportunities. Not saying it's necessarily right for everybody, but let's look at some opportunities to maybe look at some tax strategies now instead of waiting until the end of the year, or maybe looking at maybe putting some money back into the market on some of your safety pieces to see if maybe, there's some opportunities there.
the folks aren't comfortable, with going into the market, then the other avenue is, I'd actually like to offer to get a new holistic retirement book in any folks' hand that want to call into the office or even stop by to pick it up. It's an excellent book talking about the taxation and tax strategies and different opportunity zones that they have for a footprint of some tax-free growth and tax-free wealth. If that's you and you're listening and you like to read books, it's a quick read. It talks specifically about taxation and using certain sectors to be able to do so. So you can reach out here at 877-222-8849. And realistically, some folks are calling in saying, hey, I kind of moved some funds into cash. I want safety. And if that's you, there are some tax-free accumulation vehicles to do so that does give you the safety and it will still participate and be able to hedge the inflationary risk that we're looking at currently. So again, if that's you and you want to have a visit with us, or if you'd like to get the Holistic Retirement Book in your hands, please reach out to us at the office here at 877-222-8849.
So again, that's 877-222-8849. There's no cost, no obligation. Great opportunity for you to come in and chat with the team or to get that Holistic Retirement Book. Great opportunity for you. There's no cost. The team's here to help you. 877-222-8849. We're just getting started today with Nolan and Mindy. This is Wealth Michigan with the McIntoshes. We got a lot to get to. Stay with us. We're back right after this.
According to the U.S. debt clock, in the time you hear this commercial, our nation's debt will go up by $1.5 million. That's $2 billion a day, $15 billion a week. Right now, our debt is more than $30 trillion and climbing fast. The question is, how do we pay it off? The answer is increasing taxes. Now, think about your retirement accounts. Do you want to pay taxes on some of that money now, when rates are historically low, or later, when rates are potentially higher? Whether you should pay taxes now or in retirement depends on a lot of things. Mindy and Nolan McIntosh and the team at McIntosh & Associates know what to look for. Mindy and Nolan can help you create a plan so your retirement is as tax efficient as possible. Call 877-222-8849 to set up a visit with Mindy and Nolan McIntosh and McIntosh & Associates. That's 877-222-8849. Firm offers insurance services and may not give tax advice. Investment advisory services offered only by duly registered individuals through AE Wealth Management, LLC.
Get started today to develop your own dream-focused wealth plan with the team at McIntosh & Associates. Schedule a complimentary first visit today. Call 877-222-8849.
For decades, it was a reliable way to allocate your money for your retirement, a safer formula for success in the future. How could it all go wrong after serving retirees well for so many years? What could have brought about the demise of the beloved 60-40 rule? Welcome back to Wealth Michigan with the McIntoshes, Mindy and Nolan. I'm Mark Elliott. Obviously, this is what the team is McIntosh & Associates is here to do, is help you create a retirement plan: income, investment, taxes, healthcare, legacy planning. Social Security's in the income part, Medicare's in the healthcare part. A lot of moving pieces. If you have any questions, you can always give the team a call, 877-222-8849. And you can always go to the website to learn more, wealthmichigan.com, wealthmichigan.com. Let's break down what we know about the death of the 60-40 rule to help us figure out if it came about due to natural causes, or is there a killer out there? Or is there a surprise twist and 60-40 still alive and well? This is a true crime edition, I guess, today of Wealth Michigan with the McIntoshes.
So it's not dead. Now, to be honest with you, 60-40 isn't right for everybody. So I think that's the other part of that is, instead of using generalities, we have to be specific with what client needs are. But the reason why 60-40 got so popular was because, basically they're saying you get 60% of your portfolio should be in stocks, 40% should be in bonds. So that way, if we're going on the true statement that we can't do market timing, that the 60, basically, 6% that you have in stocks, most of the time that's going to work and it's going to give you great growth. But, the other part of the time, if the truism is that, 20% of the time the market is down, the bonds are supposed to be there on the fail safe to say, okay, we're upholding, some of the protection of what we've earned in stocks, because now the stock market has started to pull back a little bit. So that's kind of how they got to that 60-40 rule, and it's worked, throughout the years. And I don't think it's dead. I think it's one of those things that we look at as from a standpoint of, depending on how we're allocating it and depending on how we're managing it, a 60-40 rule can still work, how we shift it. And so there's a lot of different types of ladder bonds we can use. There's a lot of different types of treasuries versus corporate bonds. And so when we just say a 40% rule on bonds, maybe we change the structure of what types of bonds we're holding in our portfolio. And the 60% of stocks, what kind of stocks are we holding? Are we holding large cap stocks, mid cap stocks, small cap stocks? And so that's when we look at, okay, if we're strategizing with our clients on, kind of where we want to be for risk, that 60-40 rule still may be alive. It's just how are we investing in different investing strategies, right? Are we doing tactical versus strategic investing? And is there something else we're putting in there as a buffering tool? So the great part about the 60-40 rule is I think it still can be there. I don't think it's dead. I just think we have to look at it from a different lens instead of, just saying, hey, I'm good with, an S&P 500 index fund in the 60% and, a treasury in the 40%, bond world. So I think that's where I think a lot of people have thought that it's dead, and I don't really think it is.
Yeah, and that kind of makes sense. I mean, bonds are still there. It's just which ones, and right now bonds aren't doing well. They keep raising the interest rates to fight inflation. That makes your bond values go down. But there are other options in that bond world, I suppose. There's so many moving targets here. I always think that, if you're in the Wall Street world of investments, you're in the insurance world with life insurance, annuities, all those kind of things, there's so many options that you don't even realize. And what you don't know, you don't know. I think if you have questions about all of this, whether it's the 60-40 rule, whatever it is, hey, will my money last as long as I do? That's a big question. 877-222-8849 is the number. Again, there's no cost. 877-222-8849. The team's here to help if they can. So you think about it, I mean, it kind of made sense, right? Typically, bonds and stocks would go opposite directions. I mean, if stocks were good, bonds were good. That was a good thing. But if the stock market went down and the actual stocks went down, bonds kind of held on. If stocks got really taken off, bonds maybe went down a little bit, but they hardly ever went at the same time. Now we know, that 1931, 1969, and now 2022, stocks and bonds both down in the same calendar year, only 3 times in history. So the idea was behind the 60-40 made a lot of sense. But I think I'm kind of like Nolan. It's not dead and gone. Do you buy that? It's just kind of maybe in remission.
I agree about that. Kind of like your medical or healthcare checkup. It's one of those things where right now, yes, there's this teeter-totter. And with us having young children, we explain this to our families a lot that come in about what's happening with bonds. So currently right now, we're much more an advocate of using a bond alternative. So for your safer piece of what you're going to call the puzzle of where, hey, we want to be a little bit more conservative, we actually can move to using an indexing vehicle to give them the safety that they need and use it as the bond alternative. So that way, when the market is rising, they can participate with the upside of the market, but they don't have to keep losing money when the market is not performing the way that they'd like to see it. And we have other factors that make this option so viable, and the fact that as we look at increased healthcare costs and inflation, of course, that we've already talked about, it's a way to give you the stability along with providing you some income and some guarantees and safety inside of that puzzle. So you're not such a, hey, everybody comes in a cookie cutter 60-40. Absolutely not. And we need to trend the other way currently because bonds are just not the strategy to go, as Nolan spoke of. So we use an alternative to give people, just kind of having that sincere sense of relief almost. Even as we're doing some strategic reviews with folks, they see what's happening in their risk account and they see what's happening in their safe account. You can kind of talk about it being red and green money and even color it up and talk about this is what's happening with where your guarantees are and your safety. And we're looking to the future. And this is where we're actually sitting right now in the volatility. But if we're not drawing from that position right now, how do we make some adjustments to make sure that we're looking at current market environment? So we're not always looking hindsight. And we're not just leaving things in one strategy. We're making active movement with folks and continuing education, which is so key. So if you're listening and you'd like to have a visit to review where you're currently at, we'd love to have a discovery with you. You can go to wealthmichigan.com and set that up. You can stop by our office here in Freeland, or you can call 877-222-8849 and we can take a look for you.
Yeah, so it makes perfect sense. And I'm glad you're with us today for Wealth Michigan with the McIntoshes, Mindy and Nolan. From McIntosh and Associates, I'm Mark Elliott. Glad you're with us today. Talking about the 60-40 rule. And it basically was, hey, you're going to have 60% of your money in the stock market, 40% in bonds. Now, they're both in the stock market, but stocks in one, bonds in the other, right? Then when you got older, Nolan, the idea was you'd flip-flop, right? Now you'd go 60% in bonds, 40% in stocks. And Mindy's idea of the alternatives, that maybe there are times that maybe bonds are not the way to go, but you gave us a list of other types of bonds that might be able to fit in there. But it's almost like the 60-40 rule is still here. It's just maybe the interchangeable parts are different.
Yeah, and that's the part is that, I don't think a lot of investors want to hear us say, oh, well, don't worry, they'll come back. obviously investors want to know, are we thinking about it? Now, maybe that's the case. I'm not saying it's wrong, right? I'm just saying, are there other things we can look at instead of just saying, hey, hold on, it'll come back eventually? Well, what's eventually? There's no objective data there. And how do you know how much is going to come back, And so really analysis at this point in time, obviously, the 2020 is so funny, right? Because people forget that 2020 actually had a bear market to it and it actually came back so quickly. It was what we call V-shaped recovery. Obviously, this is not how this one is going to play out. This is going to be more of a U-shaped, what we call recovery, where it's filtering down, right? Started in January, it's going to filter down, and it's going to trickle down at the bottom for a little bit here, and then it's going to go back up. Now, the positive news about that is obviously bear markets only last so long, right? On average, they're usually not even, half a year. So, when we're looking at those law of averages, we should hopefully, can't guarantee anything, but we should hopefully be out of some type of market trend like we are now by next year, because really the bear market started in March of this year. So what we're trying to do is we're trying to say, okay, yes, we need to look at some alternatives and we need to look at some things and try and make some changes actively and try and maybe do some different strategies. But we're not always, most of the time saying, hey, let's hold on. We always are trying to say, okay, is there some opportunities that we can look at? Or is there some things we can make changes to the current portfolio and see if there's something else we can do instead of just saying, hey, good luck type of thing. So it's one of those things that as well, when the bond alternatives come into the play, that we want to look at. And again, it's a different strategy. I don't think there's a lot of people talking about it. They say, okay, we still need to stick with the rule of that the bonds. And if you talk to, there's one analysis, he's called the bond king out there. He says, well, just like the stock market, bonds are on sale right now too. So maybe you should be buying more bonds. I don't know if I agree with that statement, just because it's going to be a while before bonds return. But it's one of those things that, from our standpoint is there something else that we can look at? And, like we always say, we don't know unless we see your story, because every recommendation we make is on a client by client basis. And some clients are okay with recommendations that we make. Some are saying, maybe we should just stick with it a different way. But it's one of those things that we just want to meet with our clients and say, okay, where are we and what should we do next based on what your feelings are. And so then we help them walk through that. And so if there's any questions on that, obviously we'd love to help from that standpoint. So 877-222-8849.
So, Mindy, when people come in for the first time, sit down with the team at McIntosh and Associates, do you give them a list and say, here are 10 typical financial rules of thumb? Which would you like to use today?
No,
because that's really what the 60-40 is, right? It's a rule of thumb. I mean, it could make sense, but you're going to go and make everything specific to whomever you're sitting down with, like Nolan has said.
We do. So what we do first is I really like to sit in that discovery meeting, get to know more about them. When are they looking to retire? Are they already retired? Are they relocating to move with family? Are they spending time with grandchildren? And what's truly very important to them? So as we look at this, some folks are willing to take more risk. Others not so comfortable with that. Their timeline is differentiating factor. Other debt load they may have. Expenses are different. Some folks, are spending more in current times or even in retirement than others. So we have to look at all of these factors and even things of the guarantee side. Do they have a healthy Social Security they're going to receive? Are they receiving a pension? So there's so many factors that takes a look at. There's not just a mold of these rules. We really need to take a look at, what is your expenses that you're doing or a budget you have? What type of investments do you have? What is liquid in the bank? Are you still working? And what is your plan? So as we look at that, this is how we then create your Dream Focused Wealth Plan. And we help you with what's happening with your investment platform. What needs to be safe and conservative for you for your income piece? How does that all build into your estate plan? And how do we look at taxes and an efficient tax plan option for you? And then what are we doing with healthcare? How is your health? What does longevity look like? How does long-term care fit into that piece as well? And we mold that into working with you that continues to change and update, and we walk alongside you. So if you'd like a visit to get started on a planned path of visiting with us, reach out to us at 877-222-8849, and we'll walk through that together.
So we're going to talk a little bit more in the next segment about this 60-40 rule. And of course, Mindy will wrap it all up in our final segment as well today. This is Wealth Michigan with the McIntoshes. We're back right after this.
If you're close to retirement, you probably hear about Medicare all the time. When to sign up, how to sign up, what your options are. But have you heard how you might be able to lower your future Medicare costs with proper planning before you retire? It's true. The McIntosh and Associates team can show you how. It's not for everyone, but you could potentially save in future Medicare premiums. See if this strategy could work for you. Call McIntosh and Associates now to set up your visit to start working on your plan. 877-222-8849. That's 877-222-8849. If you want to pay the lowest price for your future Medicare coverage, start planning today. Set up your visit now with the McIntosh and Associates team. Call 877-222-8849. Firm offers insurance services and is not affiliated with the U.S. government. Investment advisory services offered only by duly registered individuals through AE Wealth Management, LLC.
Medicare open enrollment begins October 15th. If you have questions about your current plan or starting a new one, call the team at McIntosh and Associates, 877-222-8849.
Welcome back to Wealth Michigan with the McIntoshes. Mindy McIntosh, the founder and president. Nolan McIntosh, who's the market guru, can help you with your stocks and bonds. And how do I figure that out? My 401k, in-service distribution of a 401k. I'm 59 and a half. I'm going to retire at 65. Hey, can you put my 401k in a better position? Most companies allow you to do it. Not all. So there's some things you need to find out. You don't just do willy-nilly things. You don't, hey, I'm going to take a whole bunch of money and move it into the Roth world. No, you need somebody that understands this world to make sure you're making the right decision. It's not just always making decisions and going forward. The team at McIntosh and Associates are here to help you. Give them a call. They'll help you. 877-222-8849, 877-222-8849. You can always go to the website and find out more, wealthmichigan.com, wealthmichigan.com. We're talking about the old 60-40 rule. And the 60-40 rule is basically you had 60% of your money in stock market, 40% in bonds. And then when you got older, you flip-flop that. Well, because of the rising interest rate environment that we're in, you think back to 2009 when, interest rates were down to zero just about, and they stayed really low until really after the pandemic. And then interest rates start going because inflation starts going. So the Federal Reserve fights inflation by raising the interest rates, which then kind of slows the economy down. So I guess, Mindy, how do you look at this whole, because there's a reason for all of this. Bonds and the real estate market, bonds being down. Everything is controlled by other things. So, you have to keep your eye on all kinds of Washington and the Wall Street world, don't you?
Well, and you have to be careful. So you see all these articles and headline news, and sometimes the folks, you can get paralyzed by all of that. Or some of the do-it-yourselfers, it's time to look at least a segment of what they are doing to how do we actually really take a look at this in the big picture, and then use some developmental strategies, that we can help prepare people that can kind of bind and help them into these times where, okay, inflation is on the rise. So we have XYZ position in their portfolio. Because a lot of people that are in retirement, we're looking at withdrawal strategies. So the more bandwidth that we have with these folks can help. Okay, inflation is high, market is down. Let's use this inflationary protected vehicle they have to draw some income right now. Oh, and you know what? They've left XYZ amount behind in the bank. So let's actually supplement with that. Oh, and what about, did you still have a mortgage, or, did you just purchase a new vehicle? Are you looking to downsize your home? So we've seen a lot of changes and transitions where folks are wondering, hey, we just sold some property or we inherited XYZ. Where is the best spot for that currently? So what we have to do is we need to blend a nice strategy that continues to update and move with them, because you can't do this pressure of the 60-40 and, continue to hold steady with that. So what I think is really important is that, we might be more of a moving that scale to taking a look at, are you having time? So what is your timeline? Are you drawing from the accounts now? Is there 3 years from that? 1 year, 5 years, 10 years? So the more time that you have, the more availability that you have inside the plan to give it time to help hedge the taxation, inflation, and kind of how the balance should be. Also, the more diversification you have inside the funds and inside your investment vehicle, it gives you a broader spectrum as well. So if you're wondering, hey, what am I going to do about this piece of the puzzle? Or even as you're looking at inflation and you're dreading the fact of retirement from the standpoint that, what am I going to do on healthcare now? Can I even afford a premium cost of that and prescriptions? What is all of this nonsense and alphabet soup? Let us help to dive into that plan with you. Let's sit down and do an analysis together for a visit, and reach out to us here at 877-222-8849, or go to our website at wealthmichigan.com and really take a look at how we can set some measures for protection.
Nolan, I'm pretty sure it was William Devane told me that I really need to get into gold now because things are rocky. But that's a part of, do you help people gold, silver? I suppose there's always times where things are good, and it's always funny when I don't know. I'm not going to say any more. I'm just going to let you talk about it. Is that an option? I guess it's an option. William Devane says it is.
Well, yeah. Well, usually when we look at inflationary measures, commodities is kind of the word they throw out there, right? And there's a lot of different commodities, right? Gold, silver, things of that nature. But when we look at, where gold is today as an inflationary, you would assume that's non-correlated with the market and it'd be a defensive, right? We call it a defensive strategy when the market's doing what it's doing, and it's a defensive strategy against inflation. Well, do you know what gold is year to date? Is it up or down? It's down. It's down. So is silver. Silver's down quite a bit. So part of that issue a little bit is his devaluation of dollar, right? Where we're at, and them printing off money. And with gold not backing up the currency anymore, that value of what gold used to be is not the same. So our defensive strategies are definitely not the same as what we used to look at in the past. And I'm not saying don't have some, maybe commodities in portfolios for some of our clients, but I wouldn't say that's where we go to. I mean, it's nothing in life is good to have in excess of anything, right? Whether it be your market accounts or whether it be, eating too much potatoes or hash browns, for breakfast. It's one of those things that
It'd never be too much hash browns.
Well, we did talk about that off air if anyone was listening. But anyway, the point being is we don't want to be over diversified in something either, right? So we just don't want to be overexposed there. So it's not that we don't want to maybe a portion of that in there, but we want to be, I don't care if we're talking about a 60-40 rule, an 80-20 rule, or 100-1-0, right? I don't care what we talk about when we look at portfolios as far as percentages of bonds to stocks. The biggest key is making sure that we're well diversified. And diversification means we're not holding just one stock. We're not just holding one bond. We're, our philosophy here is that, exchange traded funds are a great place to be. They give us exposure to multiple different companies within one fund and going across different asset classes, meaning mid caps, small caps, large caps, commodities, real estate. So it's why, from our standpoint, if one sector isn't doing better than the other, then maybe the other sector is bringing it up. And so if we're diversified in our nature, depending on no matter what, right, on 60-40 or 80-20 rule or whatever you want to call it, we should hedge a lot better no matter what the market's doing. Not saying that we're going to be up when the market's down, but we're at least going to do better than what the market's doing. And so that's why, from our standpoint, we really want to look at it as it's not so important sometimes on the mixture. It's important on how diversified we are and how we're allocating and actively managing some of these accounts, so that way we can try and hedge as much as we can when we're in the negative. And so I think that's the key, and I call it silver linings, is that, when we look at S&P 500 and Dow Jones and NASDAQ, are our clients doing better off by being well diversified than just being in those types of funds? And they are. And so that's the key, is making sure that we're diversified. So if you ever want us to look at some of those accounts and say, hey, I want a second opinion on where my funds are, 877-222-8849, and we'll be happy to look at it and at least give you education on where you're at now.
Yeah, so we're talking about the old 60-40 rule. 60% stocks, 40% bonds. You get older, you flip-flop those numbers. But because the Fed has raised interest rates now 5 times this year, they still have 2 meetings to go. You think about it, interest rate hikes in 2022, because Nolan and Mindy have talked about the teeter-totter effect. Interest rates go down, bond values go up. Interest rates go up, bond values go down. So they work opposite. So that is putting pressure on the 40 of that 60-40 theory. The stock market is struggling itself, so that's putting pressure on the 60 in the formula. And then you go back to really the January through July, it was the worst start in over 50 years in the stock market, and almost 48 years, the worst start ever for bonds. So it's just a kind of a double whammy. And Nolan brought it up, the old 80-20. Maybe it's not 60-40 anymore. Maybe it's 80-20. But I think you're kind of hit on the point, Mindy, that it's really more about what options are there. I think most people, not everybody, I can't ever say everybody, most people probably need money in the stock market for growth. But that other side of it, that 40 part that we're talking bonds, that there are alternatives that I don't know if everybody even understands that there are alternatives.
That's the trouble too, is they don't realize. So we literally, maybe it was a month ago or so, we had a almost like a lunch and learn, and we are going to have these coming up here in our local area at Baines. Even this month, we're doing a lunch and learn talking about long-term care. But this one in specific was talking about, even if we utilize that, talking about how do we help hedge inflation? How do we look for tax advantages? And how do we create some safety? We just had a visit, this book too, if you want to get your hands on it. It will talk about using a section of the tax code that a lot of folks didn't realize was even available to them. They wonder, gosh, what if I could have even done this, 3 years ago or 5 years ago? It's great that we have the opportunity now. But that's why I think it's so important. Don't try to do all this yourself. We all have different things that we're educated in. We would love to have the opportunity to visit with you, see if some of those might fit into your program and your platform. And, if you go to our website at wealthmichigan.com, you're going to see that we have these little lunch and learns that are popping up each month about different topics. We're doing long-term care this month. Then we're going to move into Medicare. We'll talk about inflation a month, taxation, market returns. It's just an hour out of your day. We're going to treat you to some lunch over at Baines, and you can hear about some of these opportunity zones that maybe you didn't know were available. So reach out to us here at 877-222-8849. Again, 877-222-8849. And we'd love to have, the opportunity to see you at some of these upcoming events. And again, our next one is at Baines, and then we'll be doing those monthly. So you should check it out.
Can they sign up on the website, wealthmichigan.com? You said you can go there to find out about them. Can they sign up right there?
They can absolutely sign up right on our website at wealthmichigan.com and attend any of these events. We are hosting them primarily on Thursdays. They do have a little bit of limited seating, so when you have time, go ahead and check out a topic that might interest you, and we'd love to see you there.
So you can go to wealthmichigan.com to learn more. You can call the team if you'd like to learn more, but you can also call the team if you want to come in and sit down and let's start talking about where you are on your road to retirement. 877-222-8849. Should you be doing something different? Are you on the right track? We always hope, we think maybe we're doing the right things. We don't really know. Why not talk to a retirement planning firm like McIntosh and Associates? This is their wheelhouse. 877-222-8849. Headed to our final segment right after this. This is Wealth Michigan.
To learn more about the team at McIntosh and Associates, check out their website anytime at wealthmichigan.com.
Welcome back to Wealth Michigan with the McIntoshes, Mindy and Nolan. You can always find out more on the website, wealthmichigan.com. They're here to help you create your plan for retirement. It's called the Dream Focused Wealth Plan. It starts with a discovery meeting. They need to find out about you and your hopes and dreams, your bucket list, all of that. Then they analyze. Then they come up with some solutions for you. Then, if you want to become a client, they'll implement this plan for you. But that plan is not written in stone. Life happens, things change. It's updated for the next 20, 30 years, if you will. It's really all about you at McIntosh and Associates. 877-222-8849, 877-222-8849. No cost to sit down and chat about where you are on your road to retirement with the team. And of course, you can always find out more at wealthmichigan.com. We are coming up again on the open enrollment for Medicare. And Medicare is so easy because there's only like one option or two options, right? I have to pick A or B and then I'm done. Oh, wait, there's like 9 million options, Mindy. Help us. Open enrollment, October 15th through December 7th, Medicare. What is it? And we have to be at least 65 or at least within, 7 months of it? How does that work?
So it is the alphabet soup of confusion for a lot of our families as we talk to them as things, kind of move forward. So, some folks, this is the first time they're even talking about Medicare and getting all kinds of information, materials. You see TV ads, television, radio, phone calls ringing, and the paperwork just piles up. Well, we like to help at our office kind of declutter all of that for you. So if you're turning 65, you have the 3 months prior, the month of, and up to 3 months after to decide, hey, do I need Medicare A and B? What is it going to cost me? And then how do I know if I need to take a supplemental plan that's going to help fill in the gaps of that 20% that Medicare Part B isn't covering? But then what about the Part D prescription? And, hey, what's a viable option for dental insurance? And maybe you need hearing aids. So just taking a look at that versus, Medicare Advantage options and more of a bundling healthcare effect. So realistically, what we like to do with families, we sit down, we basically hold your hand and walk all through that. And maybe you're starting at the beginning and we're helping you get set up for Medicare itself. And we're walking through what the plans look like and the physicians you see and the prescriptions you take. And if you travel, to walk through the when, whys, and hows and make sure that you're not going to enter any penalty type of zones for enrollment timelines that you weren't aware of. And on the flip side of things, that can happen all year long as you're turning 65 years young. But on October 7th, that is a time of the year where families that have already had some sort of Medicare supplement, Medicare Advantage, Medicare Part D prescription, or just original Medicare can review plan options, carrier choices, make any changes or updates, or maybe you just want to look and, hey, are my prescriptions still looking okay in the formulary? Or maybe you hit what's called the coverage gap every year on prescription drug. And maybe you want to change a pharmacy or a physician and you're wondering how that might change your protocol. So let's take a look. Being independent, we can look at a platform for you and take a look at all of the carriers, plans, and products available in the state of Michigan, compare them for you, do an apples to apples, and be able to make any recommendations of staying where you're at or updating for the renewal for next season. So I encourage all of you to make sure you at least get a checkup. I'm calling this your Medicare checkup. You can reach out to us here at 877-222-8849. We're happy to do this visit via phone, in person, or virtually. And if you want to find out more, we also will have some little pop-up invitations from webinar series that we're running. Or if you're really a face-to-face and you'd like us to treat you to a lunch coming up, you can also, join us at our local events that we're having here at Baines and Freeland. And this next one for Medicare there is going to be Thursday, October 27th at 12 o'clock. We're going to serve lunch and talk about Medicare.
The open enrollment, October 15th through December 7th for Medicare. And the problem with Medicare is you don't even know the changes yet, right? Cost of living adjustments for Social Security that last year bumped up Premium Part B by almost, $25 to $30. They're going to raise the cost of living adjustment for Social Security again. They're going to bump Medicare Premium Part B, but you don't really know the plans until right before you get into the October 15th timeline, do you?
Well, we have all the plans. I've personally known about the plans for about the last 30 days, so I do know all the plan changes. Come talk to us, and we'd like to share more. So visit us on the web at wealthmichigan.com or reach out at 877-222-8849.
Firm offers insurance services. McIntosh & Associates Incorporated is an independent financial services firm that utilizes a variety of investment and insurance products. Investment advisory services made available through AE Wealth Management, LLC, AEWM. AE Wealth Management and McIntosh & Associates Incorporated are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. McIntosh & Associates Incorporated is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by McIntosh & Associates Incorporated.